The session will be handled by CA Ramakrishnan V, Chartered Accountant, Kozhikode. And the session is chaired by Dr. Ramakrishna Bandaru, Assistant Professor, Department of Commerce and International Business, Central University of Kerala. I request our resource person to kindly occupy the seat on the dais. Our chair will be joining us very soon, within 5 minutes. Now, I would like to take this opportunity to give a brief profile of our distinguished resource person. It's my privilege to introduce our distinguished resource person, Ramakrishna V, Chartered Accountant, Kozhikode. With over a decade of professional experience, he has built an impressive career spanning corporate finance, audit, taxation, consultancy, and academia. He began his professional journey with the business finance team at Tata Consultancy Services, Chennai, before serving as audit manager at Mrs. Verma & Verma, one of South India's leading chartered accountancy firms. Drawing on this rich experience, he co-founded Mrs. SBRV and Company, Kozhikode, where he provides expert services in direct and indirect taxation, statutory and tax audits, and financial consultancy. Alongside his professional practice, CA Ramakrishnan V has managed and maintained a strong commitment to academics. He has served as a visiting faculty at several reputed business schools for MBA programs and at the University of Calicut. He has also presented research papers at numerous national level and UGC-sponsored seminars on topics related to finance, accounting, and taxation. With his extensive professional expertise and academic experience, we are delighted to have him with us today. Welcome, sir, to the session. Our chair will be joining us very soon, so I request Dr. C.V. Ramakrishnan, sir, to take over the session.
So, good afternoon, everybody. Respected chair of the session, respected faculty members of this institution and other distinguished speakers who are present, and dear students. First of all, let me take this opportunity to thank this institution for, first of all, organizing such a seminar which is spanning a period of 3 days and which is expected to convey the message of GST to all the students with particular special focus on students, and also thank them for giving me this opportunity to interact with each one of you. Now, my session, I propose to handle 2 sessions today. So one is the pre-lunch session and post-lunch session. So I've got 2 challenges. By the end of this session, we'll all start feeling hungry. And beginning of the next session, we'll all start feeling sleepy. So please cooperate. I also request you to keep the session lively by asking questions. So we have a dedicated section towards questions, both in this session and the afternoon session. But even in between, as I'm speaking, if you do have any clarifications, I will welcome if you raise your hand and pose a question. That makes the session a little more live, and it gives me a feedback that what I am speaking is getting conveyed. So with this brief introduction and note of thanks to this institution, let me begin. This. Which is the. This one is for next. Okay. It's not going. Yes, please, please.
The session is chaired by Dr. Shani P., Faculty, Department of Commerce and International Business, Central University of Kerala. I welcome you, sir.
Yes, am I audible? Yeah. Okay. I'll see where I'm more comfortable. Maybe I will switch back there. Let's see. So, I'm sure most of us are already aware of the fact that GST is an indirect tax. Much would have been said about it, I think even in the previous session. Essential distinction is indirect taxes are collected by one person and borne by another person. That's why it is called indirect. Income tax is a direct tax. I earn income, I pay tax out of my own pocket. Direct tax. Indirect tax, I am doing a business, I am responsible for collecting the tax from my customer and paying it. Ultimately, the cost of indirect tax is on the final consumer because that will be inbuilt into the price. The final consumer at the end of the supply chain will be paying the tax. This is a fact which we have understood. This is the essential distinction. To put it in a slightly humorous way, income tax is a direct tax which you earn, which you pay on your earnings. So when you earn income, you pay income tax. When you spend money, you pay GST. So putting it in a light way. All right. So the point is, GST ultimately is borne by the end consumer. Therefore, indirect taxes are generically called consumption-based taxes. There's another smaller aspect to it. It's also called a destination-based consumption tax. Why so? Why is it called destination-based consumption tax? Because they say, see, this is a tax on goods as well as services. It says that tax follows the goods or services, which means it is consumption based and the tax follows the goods, the tax follows the services. So it simply means if I sell goods from Kerala to Tamil Nadu, who gets the GST? Which state earns the GST? Tamil Nadu earns the GST. Kerala is a consumption heavy state. So that way, Kerala will be earning significant amount of GST because of consumption. So the tax goes to the state where consumption happens. Now that I have mentioned this, I propose to cover 2-3 areas in my sessions. One is, let us understand the legal framework. Second, let us understand the operational aspect, the structure of the tax. Post-noon session, I plan to talk to you about how the GST returns are filed, plus various miscellaneous issues that come up, like frauds, etc., tax evasion, how that happens, and how the GST mechanism is getting designed and improved to prevent it and bring more people into the tax net so that our economy progresses because of better tax collection. So that part is for the noon session. So a little bit it helps if we try to understand the legal framework based on which this tax is based, and now we are calling it next generation GST reforms. Why is it called next generation? To appreciate this fully, we should know what was there before GST also. Although it is now probably getting irrelevant, but to appreciate the beauty of GST, we should understand what was there before. Not that it was bad, but this is a very significant improvement that we have made when GST was implemented. So a little bit about the legal framework. Now, I'll spend probably 10 minutes on this. So basically, any tax, if it is to be levied, there should be a constitutional backing. Because as we know, any law passed in the country has to have constitutional sanction. There is an entry in the Constitution which says, no tax shall be levied except with the authority of law. There is an article, very important one, Article 265 of the Constitution, which says, no tax shall be levied except with the authority of law. So there should be a law which allows a government to collect tax. There should be a law which allows the government to collect tax. Not only that, the Constitution also lays down on what all activities tax can be collected. So I use this example. Can some government tomorrow decide if you are sleeping for more than 10 hours in a day, you have to pay tax? Any sleeping beyond 10 hours, you have to pay tax. 100 rupees per hour. Can such a tax be implemented? Answer is no. Why? Why? Simple answer is Constitution says these are the subject matters on which tax can be levied. Taxes can be levied on income. Taxes can be levied on services. Taxes can be levied on transfer of goods. Taxes can be levied on road transport, on registration of property. These things are laid down in the Constitution. And we have to also appreciate the next fact that India is federal in nature. We call it semi-federal or quasi-federal. Now what does it mean? You heard of federal bank, but that's just a word. So what is federal? It is a federation of states. So basically, what is a federation of states? Our states have got certain independent functions. They can function independently in certain respects, but at the same time, we are a federation of states with power which is divided between the center and the states. So this is how, because our country is very diverse in terms of language, in terms of culture, we have got linguistic division of states. So every state has got its own culture, so certain laws and certain practices may be necessary to preserve the identity of a particular state. So this is why the Constitution has put such a structure. Now when we have this kind of a federal or semi-federal structure, we call it semi-federal because it is not fully federal. Now what is fully federal? United States of America is a little more federal because some of the states, I believe, have their own constitution also in the US. We don't have that. We had it for Jammu and Kashmir, which is now removed. Jammu and Kashmir doesn't have a separate constitution now after that Article 370. So once that is so this is the idea of federal structure, and the Constitution lays down what are the subject matters on which tax can be levied by the center and by the state. So pre-GST, income, that is the income tax that you are earning, that was deemed to be a central subject for which the central government has to levy tax. Even today, that continues. So income cannot be taxed by the state government. Income can be taxed by the center. Salaries, rental income, profits which you make on your business, all that can be taxed by the center. Income tax. So it's a direct tax which is levied by the center. Then there were other taxes like taxes on sale of goods, taxes on services. Now take goods and services. Pre-GST, the constitution gave power only to the state to levy taxes on sale of goods. That used to be called sales tax. Then sometime I think in 2004, it was all replaced by a value added system of tax, which is we call VAT. VAT is actually, it's not the name of a tax, it is the method by which we collect tax. In fact, GST is also VAT only. So, I'll explain more on that a little later. So, 2004, the old government sales tax acts were replaced by VAT. They called it VAT. It was only on goods. Sale of goods, that too, very specific. The right to tax sale of goods was given by the constitution, that power was given to the state governments. Sometime in the 1990s, I think when Dr. Manmohan Singh was finance minister, the concept of service tax was brought in. Taxes on services. The power to tax services was on the center. So they brought about this legislation through the Finance Act, which is called service tax. So they started with 2 or 3 services. I think one was stockbroking, then insurance. 3 services they started in 1990s. And over time, more and more services were added. And sometime in 2007-8, that time, they said all services are taxable except a few. This is the history of service tax. So the entire revenue of service tax was going to the center. So services were taxed separately, goods were taxed separately. Similarly, manufacture of goods was taxed by the center, which was called excise duty. So when you manufacture goods, you have to pay tax to the center. When you sold those goods each time, you had to pay sales tax to the state government. When you rendered services, you had to pay taxes on services, service tax, again to the central government. So even take the case of goods and services, 3 taxes, and different states had different laws. So just imagine somebody is doing business in India, in multiple states. You have to comply with the tax laws of different states. Each state had a different rate of tax for the same product. And one business entity would be rendering services, would be supplying goods, they would be procuring services, they would be procuring goods. So, having different laws for different aspects of the same business was not thought to be logical. And that is why the idea of GST came. Another controversy also I will come to it, why this confusion of goods and services was coming. So, this is why it was not felt that it is in the long run, it will not be feasible to have separate taxes on goods and separate taxes on services, and therefore the idea of GST came. However, it is important to note that the sovereignty or the federal structure has to be kept intact, which means state government has to have its own revenue, central government has to have its own revenue. Because earlier the bifurcation was very clear. Sale of goods, let the state collect tax. Services, let the center collect tax. Manufacture of goods, let the center collect tax. This was there. So if you change that structure, the revenue pattern of the states would undergo a significant change, which is why there was a lot of difficulty in implementing GST, because GST brings together goods and services, and the revenue pattern of various states would get disturbed. It may improve over time, no doubt about that, but everybody will be unwilling for a change. So that's why the implementation took a lot of time, because it needed the consensus agreement of all the states. So once that was achieved, there was a constitutional amendment for this, which said concurrently the state and the center could concurrently levy taxes on goods and services. So to implement GST, we needed an amendment to the constitution itself, Indian constitution, which said it gave concurrent power to the state and center to levy taxes on goods and services. And that is the reason why today if you go and purchase a product from a shop here, you will see CGST and SGST. One is the share of the center, second is the share of the state. From the share of the center, and there is another allocation to the state, that's a different matter. But SGST component 100% goes to the state government, CGST goes to the center. And that is again reapportioned, those things are there. So this is why we have to understand the framework and the reason why GST is structured the way it is. My point is coming through? You have any questions on that? Please feel free. So now that we have this structure, we need so the constitutional sanction has come. No tax shall be levied except with the authority of law. So constitution has permitted you to levy tax on goods and services in this way. Now, constitutional permission is there. Over and above that, there should be a law. So constitution says, okay, you levy tax on goods and services. So who makes the law? Any answer? In our country, who makes the law? The CGST Act, the SGST Act, the Income Tax Act. Who makes the law? One answer, please. Parliament, good. Sometimes I hear the answer government from some. No. Parliament makes the law. Government, so Parliament is called the legislature. Who implements the law? Government. That's called executive. So government has got executive powers. Implement the will of the people. Implement the will of the Parliament. That's called executive. Then there is the judiciary which interprets law. That's the system of courts. The judiciary interprets the law, sees if there is anything unconstitutional, settles dispute. That is the function of the judiciary. Right. So this is the brief history. Now I told you I'll just tell you one or two interesting things which you can easily appreciate about why a single law is necessary for goods and services. Certain things today, it is very difficult to classify whether it is goods or services. For example, you buy a cup of tea. Is it goods or services? What do you think? Cup of tea from a restaurant. Goods or service? Goods, right? That's the obvious answer which you see. But then you can ask the next question. If I go to an ordinary restaurant, I pay 20 rupees for a cup of tea. If I go to Taj, I pay 200, 300 rupees for a cup of tea. Why? Equally good tea. The local shop might have more tasty tea. We don't know. Rather than a 5-star hotel. But why do you pay 200 rupees there in a hotel and pay 20 rupees here? It is for enjoying the ambience. So there, paying 200 rupees for a cup of tea is service. Here it is goods. Makes it difficult. Taxation was made difficult because of the simple reason that earlier the power to levy tax on goods was with the state. On services, it was with the center. So, restaurant business became a huge issue of dispute. The service tax department came forward and said, we want tax on it. The state sales tax departments also came forward and said, we also want tax. How can you tax the same good twice? One by the state and one by the center. Another example I can tell you, software. Software can be just installed, or you can put it into a CD or a pen drive and then sell it over the counter. Just because I put it in a pen drive and sell it in the counter, does it become goods? Just because I upload it, does it become a service? This issue was there in software also. Lots of litigation was going on, and some of those litigations are still going on under the old law. It is with the Supreme Court. So, another purpose of promulgating the GST legislations is to resolve or avoid these kind of litigations. So, to understand GST, it is very essential to appreciate the federal structure of our country, appreciate the fact that the center and the states need their own respective share of tax, appreciate the fact that today goods and services often cannot be distinguished from each other, and they need to be taxed together. Appreciate the fact that to do a business, even if I am selling goods, I need to take services. Right? I am selling goods, but I need certain services for selling those goods, right? So it makes sense if all these are brought under one umbrella. Another point, I am doing business in different states. India is one country, one market. Why should the tax rate in Kerala be different from the tax rate in Tamil Nadu? Makes no sense. Therefore, for all these reasons, GST was born in 2017. So, this is understood. GST is not on profit, it is on your turnover, sales. So, whether you are profit, some people ask, I am making losses, why do I have to pay GST? No. GST is not paid out of the pocket of the businessman. GST is taken out of the pocket of the consumer. So therefore, it is not dependent on profit, it is dependent on turnover. We use the word turnover in GST rather than sales, because turnover represents both goods as well as services. Okay. Now this is some very basic example for understanding how GST flows. Now I made a small indication earlier about VAT and GST. Is VAT different from GST, or is GST VAT, or is GST and VAT different from each other? That question itself is actually wrong. Because what does VAT stand for? It stands for value added tax. So tax on value additions which happen to a product over each stage. This VAT. Goods and services tax is essentially VAT model only. So VAT is not the name of a tax. VAT is the method through which the tax is collected. So GST is 100% a VAT model tax. Taxes only on value additions. So it is perfectly okay to say that GST is a value added tax. In some countries they call it GST, in some countries they call it VAT. UAE they call it VAT. It's GST only. So whether it's goods or services, we call it Goods and Services Act. But Goods and Services Tax, reinforcing fact that it is based on value added model. Now that value added model is what I am demonstrating here. So I have said here X purchased goods from a supplier for 100 rupees plus 12% GST. I have mentioned goods, it could be services also. Same thing, there is no difference. So I am buying goods for 100 and that particular product is taxable at 12%. How much do I pay? 100 plus 12. 112 I pay to my supplier. Correct? Can you tell me what is the accounting entry for purchases? Purchases? Purchases account debtor to cash or to creditor. Correct? Purchases account debit. So 100 rupees purchase, what do you pass? What kind of an entry do you pass? Purchases account debtor 100 to cash 100. Right? Now I am adding GST to it. Then what happens to the numbers? Purchases account debtor 100 or 112? We may say 112, answer is no. Purchases account debtor 100. GST debit 12. Now this GST is called input GST. Very simple. So what is my accounting entry? Purchases account debit 100, input GST debit 12, to cash 112. So this tax component, when we account it in GST, that GST is not part of your purchase cost because you are going to sell those goods. You are not keeping the goods for your own consumption. You are going to sell those goods. So your accounting entry is purchases account debit 100, input GST 12, to bank or to creditors 112. So which means you have paid 12 rupees tax on the goods when you purchased it. You have paid it out of your own pocket. Then you will turn back and ask me, but you said earlier the GST is taken out of the pocket of the consumer, not of the businessman. I have paid 112. Yes, wait. So you written down this accounting entry. Now, purchases account, when you finalize your financial statements, it will go to your profit and loss. Correct? P&L account you transfer it? Yes. But this input doesn't go to your P&L because it's not your expenditure. It is a tax which is a current asset. It will sit in your balance sheet. It's a personal account. It represents the tax you have paid in advance to the government. You have paid 12 rupees to your supplier, that supplier would have paid that 12 rupees to the government. Next step, it will be 100% clear what I am saying. Now, so the cost of goods is 100, GST is 12, total paid is 112. Third step, you see, this person sold those goods for 150 rupees. So I bought it for 100, sold it for 150. What is my profit? 50, obviously. Now when I sell it for 150, I have to again collect 12% tax on the sale value. So 150 into 12% is how much? 150 into 12%? 150 into 12%. It is there. 18. So when I sell it, I have to collect 150 rupees plus 18 rupees of tax from my customer. What is the accounting entry? Cash account debit. Money comes in. How much comes in? 168 comes in. To sales, 150. To, it's called output GST now. Output GST, 18. Are we clear? So when you purchase the goods, you have input GST, which is a debit balance. When you sell goods, you have got output GST, which is a credit balance. That input GST debit balance is a tax which you have to get back. 18 rupees output GST is your liability which you have to pay. Right? Now what can be done is, you have collected 18 rupees from your customer, you have already paid 12 rupees GST to your supplier. Now 18 minus 12, 6 rupees you have to remit to the government. Are we clear? Yes, no? So two entries, if you have written these two accounting entries, it will be quite clear. Purchases debit 100, input GST 12. Other entry, output GST 18, sales 150. So output GST is what you have collected from your customer. You cannot put it into your pocket. That is why it's called a liability. Input GST you paid out of your pocket, but you have to get it back. So you collected 18 from your customer. you paid 12 to your supplier, now you have got 6 rupees excess. That 6 rupees excess you pay to the government over. This is the core principle of GST. What I have just said, this example gives you the structure of GST. Now this input-output concept happens because the person or the entity which I am talking about here is a business. They are buying and selling goods. For the final consumer, there is no concept of input at all because the cost is on the final consumer. So the business entity acts as a pass-through mechanism. Now, this same thing may happen 3 times, 4 times, 5 times. How? First, goods are made by the manufacturer. Manufacturer gives to the wholesaler. One wholesaler gives to another wholesaler. He gives to a retailer. That retailer again sells. So, at each stage, whatever is the selling price, they collect tax on the selling price and subtract all the taxes paid up to the previous stage. That is why it is called value added tax. The goods are value is getting added on to the goods at each stage. And as value gets added, tax is paid to the government on the value additions only. So in the first stage in my example, the government got 12 rupees. Second stage, the government got 6 rupees. Total selling price of the goods, 150. 150 into 12%, 18. Government has totally got 18 rupees of tax. You can extend this as many times as you want and you will get the same result when goods are moved from one stage to another. Are we good? Yes. So, moving forward, we will use 2 words instead of purchases and sales. Instead of purchases, we will call it inward supply. Sales, we will call it outward supply. Now, what is input tax? Input tax is the tax paid on inward supply of goods. Output tax is the tax collected from customer on outward supply of goods. So in inward supply, purchases, tax paid on inward supply to the supplier, input tax, we get it back. Sale of goods called outward supply. Tax collected on outward supply from our customer is called output tax. And every month we see what is our total output tax, total input tax, subtract, pay the difference to the government. Now tell me, usually, which is likely to be higher? Will input tax be higher or output tax be higher? Generally, which is likely to be higher? Input tax or output tax? Output tax is generally likely to be higher because a business operates with the idea that its sales is going to be more than purchases, then only there will be profit. Right? In some months, it can happen that you purchase more but you sold less. In which case, your input will be higher than output. Then what do? No problem, that excess input whatever is there, you can use it for next month's output. We'll discuss an example. I hope this illustration is visible. Here I have just illustrated a profit and loss statement. Something in the format of a profit and loss account. Here I have put outward supply. Okay. So just taking illustrative transactions for a particular month. I have taken outward supply here. Let us say in a particular month somebody sold goods of 8 lakhs. On 8 lakhs, let us say the output GST, the tax which the person collected from the consumer is 96,000. 8 lakhs into 12%. I have just assumed 12% tax rate. So on 8 lakhs, there is 96,000 rupees of output tax collected. And your total collection is 8,96,000. I have put it in 2 separate columns. Now, for effecting this sale of goods, for making this sale of goods, is it enough to just have purchase of goods? Just because you purchase goods, is that alone enough to sell? No. You need a shop, you need a room, you have to pay rent on it, you have to engage staff, so many other things have to be done. So to sell goods, you will be making use of services also. What services are required for making a sale? I need to get some services so that I can sell. One, I need a room. I have to pay rent on that. I need telephone to speak to customers. I may need a transport agency to bring the goods to me. Unless I get all these services, I will not be able to sell my goods. This fact is very important. So you see, what are my expenses? So broadly speaking, outward supply is my inflow, income which is coming. Inward supply is my payments, my expenditure. Whatever expenditure I incur to run my business, those are inward supplies. Now I have just given 3 or 4 examples, that's all. Goods purchased. I have purchased goods for 5 lakhs. Again 12% tax. My input tax, I have paid 60,000 to my supplier. That supplier would have paid it to the government. So 60,000 stands as my input credit. Now my telephone bill, I had a telephone bill of 1,000, 18% tax I paid. 180 rupees also I can claim back as my input tax. Third one, I have paid rent, 20,000 rupees, 3,600 rupees rent. So all the taxes which I have paid for procuring goods and for procuring services, that is what is called input tax credit. So input tax credit means the taxes which I have paid on my inward supply of goods, and that inward supply of goods I have used for making outward supply. I have availed those goods and services to make my outward supplies. So at the end of the month, I find that I have collected 96,000 of tax. I have paid 63,780 of taxes to my various suppliers, to my suppliers of goods, to my suppliers of services. And I have to now pay the difference between 96,000 and 63,780. The difference between these two, I have to now pay to the government. This is how GST works. A very somewhat excessively simplified example. This one is. Okay. So we'll just go through these points. So a business may use several inward supply of both goods and services. Inward supplies are usually purchase of goods or availment of services, and they constitute expenditure. Outward supply can be goods or services. And under GST, the principle is that the entire input tax can be subtracted from the outward supplies and the net amount to be paid to the government. Therefore, GST is not a burden to the business. It's a burden to the customer. The price increases. Extra price is collected from the customer. Now, for this, one more point is there. Then what about fixed assets? So we said whatever is debited to the P&L account, all your expenditure, purchases, rent, then inward courier, transportation, any software renewals, all those things carry some GST, and I said we can set it off. But to do a business, you need assets, right? You need plant and machinery. That is not charged to your profit and loss statement. What happens to the taxes which you have paid? Even that is allowable as a credit. So those are called capital goods. So you can take input tax benefits even on assets, such as plant and machinery which you use, office equipments, all those are eligible for input tax credit. There is only one exception, which is a big exception actually. You cannot take input credit for immovable property. You construct a building. But the GST you have paid on that building cannot be taken. There is a specific provision in the GST legislation that it cannot be taken. Other than that, most of the assets which you use for business, whatever GST you have paid on that can be taken back as a credit. So it covers not only the items which are charged to the profit and loss statement, it covers items within the balance sheet also. Like what you call property, plant and equipment, or in common parlance it's called fixed assets. So all those tax credits can be taken. Now this process, it demands that you should have a good accounting system. So if the volume of transactions is low, maybe even a manual accounting system will work. But when the volume of transaction is high, it is not possible to be GST compliant unless you have a good accounting software. Why do you need an accounting software? Because when there is continuous sale of goods, continuous supply of goods and continuous supply of services, somebody has to generate the revenue, generate the invoices, because invoice is a very significant document under GST. Invoice is the document through which tax is collected. So a person registered under GST is not supposed to collect tax without issuing an invoice. So what is the importance of the invoice? It is the document based on which tax is collected. Give full disclosure. There is a specific format. It should contain the description of the goods. There is something called HSN, Harmonic System of Nomenclature. Every product has a code. That code has to be mentioned. Date of the invoice. What is the rate of, what is the taxable value of the goods? What is the tax on the goods? Amount in figures, amount in words. These things have to be mentioned in an invoice, and the copy of the invoice to be given to the customer. So when there is continuous sale, can somebody be calculating the tax at each stage? No. It has to be automated. You have to put in the values and the rate for that product has to be set in the system. Computer system will, the software system will take care of the tax calculations. Now, at the end of the month, you have to file this data with the GST department. There's a portal. Can you sit and total? No. Obviously, your software has to generate a report which says 5% tax sales, these are the items, this is the tax collected. 12%, 18%, whatever. Of course, 28% is no longer there now. There are very few, hardly anything under 28% now. So other rates are there. So the tax collection has to be matched with your books of accounts, and a report has to be generated from the books of accounts and declared to the tax department in the next month. I'll be dealing with filing of returns in the next session. So that has to be filed. You have to say that this is my outward supply in the last month, this is my output tax, this is my liability. Second, more difficult part, you are continuously availing purchase of goods, you are continuously availing services. You have to have an accountant who enters the transactions properly. Properly enters the transaction means what? When you get a purchase bill, I give you an example, 100 rupees purchase bill, 12 rupees input tax. When you key in the entry, even today every purchase has to be keyed in by somebody. Maybe we will come to a stage where if we scan an invoice, the AI system will automatically post it. Anyway, such softwares are already under development. But as of now, most of our businesses, when they get an invoice, they have to enter it. How is it entered? The basic amount, it's called the taxable value. Excluding the tax, the basic taxable value is your cost. That will be charged to your purchase account. And these amounts, the tax amounts are accounted as input taxes. So this robust system, a system with good integrity has to be in place so that your input taxes are captured correctly. If it is not captured correctly, it's a loss for the business because you are losing that credit. That is why in the previous session I heard one of the faculty members saying that, I think sir was saying that you need good accountants with GST. So, a good accountant has to take care that the inputs are recorded correctly. Now, when we are talking about input credits, our GST has got a very, very good system whereby the government is able to ensure that we are claiming the correct amount of input. Now, how does it happen? I'll explain that process. This is again a very core idea of GST. Now, how are these taxes paid? In a particular month, you have your accounting system. So, the past month is June. So, June 1st to June 30th, you had some sales. So, every business entity, what they have to do is, whatever sales took place, whatever outward supplies took place in the previous month, that data has to be submitted to the GST department by the 11th of the next month. 11th of the next month. So just imagine all the sellers of both goods and services across the country. Suppliers of goods, suppliers of services across the country, what are they doing? They are submitting their outward supply details online. Okay? Just picturize every business entity in India registered under GST. Leave out the small ones. Everybody is entering their details of outward supplies. So at the end of the month, after 30th June, by 11th of July, every supplier in India has filed it. Of course, everybody will not file, there will be some exceptions. But vast majority are doing it properly now. At least from what I have seen, I feel 95% compliance is there. So they are filing their data of sales by the 11th of next month. So on 12th, data is available with the GST department about the total amount of outward supplies which has happened in a particular month. Now, next very interesting point. When the sale is from business to business, okay? Sale will be happening from business to business. Sale will be happening from business to customer also, final consumer. Business to business sale is also there. Business to customer sale is also there. Why are we making this distinction in our discussion? The essential difference is business to customer sale, once it happens, that transaction stops there, end, full stop. Why? I am going to the supermarket and buying soap. Over. Now I am not going to sell this soap again. Correct? Getting the point? Whereas B2B sale means wholesaler, the manufacturer is selling to the wholesaler. One wholesaler is selling to another wholesaler. So the transaction chain will be continuing. So when this data is captured, it is important to make a distinction between B2B sales and B2C sales. Business to business sales will be continuing. Business to customer sale means full stop. That transaction has stopped there. All the tax on that transaction has gone to the government now. If it is a business to customer sale. Now we'll take up the same example. I am let us say a trader. So I have bought goods. For how much? Take that same example, 100 rupees. I am selling it for 150. On 100 I paid 12 tax, 112 was my payout, 100 is my basic price, 12 is my input tax. I sold it for 150. My tax collection on that is 18. That's my output tax. I have to now pay 18 minus 12, 6 to the government. Right? In my books of accounts, I have passed the entry purchases account debit 100, input GST debit 12, out to bank or to cash 112. Now, I bought this 100 rupees of goods from a supplier. Yes or no? I bought this 100 rupees of goods from a supplier. Now that supplier has to report this transaction as a B2B sale, not as a B2C sale. Why? Because in my books of accounts, I have put purchases debtor 100, input debit 12 to bank. Why? Because I am going to resell it. So it's my purchases. When I buy these goods, I have a GST number. I have to give this GST number to my supplier. The GST number I have to give it to my supplier, and my supplier will report this transaction as a B2B sale. Which means once he reports it as a B2B sale, his outward supply is my inward supply, isn't it? I told you a while ago, every supplier in India is now filing data relating to the sales of the previous month. That supplier has filed, I have also filed. I have filed my outward supply, he has filed his outward supply. But his outward supply is my inward supply. So when I log into my GST portal in the next month, after he has filed the outward supply, I will be able to see in my account that I have got a tax credit of 12 rupees. Unless this tax credit appears in my account, I cannot take credit for that tax. Take credit for that tax, what does it mean? This month how much I have to pay to the government? 18 minus 12, 6. If this 12 does not appear in my GST login portal, I have to pay 18 to the government. I am not allowed to subtract 12. Till such time it appears in my portal. Understood? My supplier has filed outward supply, that is my inward supply. In my books of accounts I have recorded purchases. In my books of accounts I can see a 12 rupees input. In my books of accounts I have 18 rupees output. Now I say I have to pay 18 minus 12, 6. But 18 minus 12, 6, if you are to pay, that 12 rupees should come in your GST login account. How will it come into your GST login account? Only if your supplier reports this transaction. So every month we have to see what are the transactions that our supplier has reported. It is the outward supply of all our suppliers which becomes our inward supply. So match the inward supply as per your books of accounts with the outward supply filed by all the suppliers. This is another task for the accountant. And this is how the GST mechanism works. Little more on that will be in the post-noon session, how the returns are filed, etc. But this is another core point which we need to understand for appreciating the GST mechanism. So I file my outward supply, I declare my liability in the return form. There's a statement which is called the return form that has to be submitted by 11th of a month. Imagine that every supplier in India is filing it. All the outward supply, all the sales data is captured. When all the sales data is captured, which means my purchase data is also captured, because my supplier's sale data is my purchase data. Their outward supply is my inward supply. My inward supply is also recorded in the books of accounts. I compare what is recorded in my books of accounts with what the suppliers have filed, match it. Unless my suppliers have filed it, it will not appear into my login account. Unless it appears in my account, I cannot take credit of that. Right? Okay. So I think it's 1 o'clock now. I think I have given you an idea of the understanding of the structure. I guess it's time for some questions. I hope my points have got conveyed. Regarding whatever we have discussed, please feel free to ask. Anybody? Getting hungry? Any questions, please?
The session is open for discussion. If no further questions, I request Shanib sir to offer the concluding remarks.
Respected CA Ramakrishnan sir and distinguished faculty members, dear students and participants. On behalf of Organizing Committee and Department of Commerce and International Business, Central University of Kerala, I would like to express my heartfelt thanks to CA Ramakrishnan sir on the topic of, on the wonderful section of GST concept, benefits, challenges and prospects. I can assure that this topic and your idea skill that is useful and enhance our GST knowledge, and also it is benefit for the students in their academic study as well as their future career. So I thanks to Dr. Ramakrishnan sir, CA Ramakrishnan sir, and I also thanks to the participants who are actively participate and listen the program. Once again, I thanks to CA Ramakrishnan sir. Thank you. Have a wonderful day.